Okay. So we only have two lectures left tonight, and we're also going to talk about equity next week. And then we're going to have another test, and it's going to be similar to the second test, not the first one. So it's going to be open for the week, and you'll have the opportunity to log in, take the test, but we won't have class time that week. Okay, so next class is the last time that we're going to, meet as a group. The exam will be open for a week for you guys to take. Do you guys have any questions about that or about anything else? Assignments or the the second little paper project thing, anything like that? Okay, hearing none, I will press on then with the material. Let me share my screen with you real quick. Okay. And all of these little things are always in the way. So let me get over to where the actual slides are. There we go. Can you guys see my slides okay? Give a thumbs up or a hand up or something to let me know you can see what I'm seeing. Okay, thank you. Um, so this week we're talking about long-term liabilities. Let me move this out of the way real quick. Um, we've touched on them in the past. So some of this is going to be a review. Um, but we'll just hit it again to make sure it's clear. I will say, this material drags on a bit. So if we're not able to finish it during the normal class time, I will make a secondary video sometime between now and Friday that will cover that material. Also, this particular uh, chapter has a ton of new terminology and concepts, and you know how much I love to put that on tests. So just be aware that that's, a possibility. Anyway, so our as I said, this lecture is all about long-term liabilities. They're going to differ from our short-term liabilities in that they don't need to be paid off in that 1 year or accounting cycle. Okay, this is something that's going to carry over into multiple accounting cycles. All right. They will be reported in the long-term liability section of the balance sheet. And this will encompass things like long-term notes payable and mortgages, things like that. Okay. So when we record the initial liability, this should be just a review for you guys. So on December 31st, 2025, Smart Touch Learning signs a $20,000 note payable. It's due in 4 annual payments of $5,000 plus 6% interest. Okay, so on December 31st, we record that we received this $20,000 in cash, right? It's an asset, so we increase it with a debit. And then our notes payable, the liability is a credit. That's our other account. Okay. So we have this thing called an amortization schedule. If you haven't heard this word before, you will be familiar with it if you've ever bought something really big like a house or a car. They usually give you this. schedule when you first buy your car, that shows the principal, meaning the amount that the value of the car that you're paying, the sticker price, um, and how much of that you're going to pay each month along with interest. We'll see an example of it coming up, but this is where you're probably most familiar with it. Um, so just to cover this in, dictionary terms, the amortization schedule details each loan payment's allocation between principal and interest. That means how much you're paying on principal and how much you're paying on interest, and the beginning and ending balances of the loan. Okay. Interest is computed as beginning balance multiplied by the interest rate multiplied by time. Because remember, when we say that there's a 6% interest rate, we mean 6% annual interest. Okay. So we break that down during each payment. Okay. All right. So this is an example of what an amortization schedule looks like. You have your beginning balance. Remember, the loan is for $20,000. Your principal payments are $5,000 each. And then your interest expense. Okay. So that's going to be the balance so far, times the interest rate times time. So in this particular case, it's 20,000 times 6%, times 1 year. That's $1,200. Okay. So your total payment is 6,200. But you've only paid $5,000 worth of principal. So even though you pay the 6,200, you go from a beginning balance of 20,000 to an ending balance of 15,000. Okay. So on December 31st, 2026, Smart Touch Learning must make its first installment payment of $5,000 principal plus interest. Okay. So December 31st, notes payable of $5,000, interest expense. Remember, we're reducing that liability. We owed 20,000, but we paid 5,000 of it. So we're reducing that liability account. We are expensing the interest for the period, and we're showing that we paid a total of 6,200 in cash. Okay. So, mortgages payable are a specific type of long-term debt that are backed by an interest in a specific property. Okay, so they're similar to long-term notes payable, except that they're secured with that specific property, right? If you don't pay your mortgage, then the bank gets to seize your property. Okay. So on December 31st, 2025, Smart Touch Learning purchases a building for $150,000. They put 49,925 down on the house, and they sign a 30-year mortgage for 100,075. Okay. There's 6% interest on this mortgage, and it's payable in $600 monthly installments, which includes principal and interest beginning January 31st, 2026. That's a lot. Okay. But breaking it down, the very first journal entry you have to make is that now you have this new asset, this building, okay, for $150,000. You have a mortgage payable of $100,075. Okay, that's how much you took out the loan for. And then your down payment is just reducing cash by that amount. Okay, And here is your amortization schedule for that. Again, when you buy a house or a car, you can get access to this. Um, an incomplete version of this is usually provided with your monthly statement. It'll just show what you've paid so far. So the beginning balance, how much you paid in principal, how much you paid in interest, the total payment, and then how much that reduces the overall liability, and gives you an ending balance. Okay. So when you go to make that first mortgage payment, okay, it's on January 31st. All right. But remember, you took out the mortgage on December 31st. Okay. So this is only 1 month later. Okay. So we have our mortgage payable, which gets reduced by 99.62, our interest expense of 538, and our cash is reduced by $600. Yes, this is very realistic for a mortgage, where the interest on the really big principal is the majority of your payment, and you're only chipping away at that principal. Very, very realistic. Okay, so now we're going to switch gears and talk about bonds. Okay. So finally, we're hitting some new material. Um, Bonds payable are a type of long-term debt, and it's issued to multiple lenders. Okay. Usually in increments of $1,000 per bond. This is different from stocks. Okay, with a stock, you're purchasing an interest in the company, and you may or may not receive dividends for that. Okay, with a bond, you are in essence providing a loan to the company, and they are going to pay that back to you with interest on a specific date. Okay, so again, this is going to be kind of vocabulary heavy. So we have face value. That's the amount that the borrower, that's the company who issues the bond, must pay back to the bondholders on the maturity date. Okay, the maturity date is the date that the borrower has to pay the principal amount back to the bondholders. Okay, the stated interest rate is the interest rate that determines the amount of cash interest the borrower pays and the investor receives each year. Okay? All right. So if you have a 9% bond issued at a face value of $100,000 on January 1st, 2025, you'll pay 10 semi-annual interest payments of $4,500. That is, $100,000 times 9% interest times half the year because you're paying semi-annually. Okay. In addition to the face value payment that you'll pay at the end. So you'll get this $4,500 twice a year up until the bond matures, and then you get your $100,000. Okay. So, types of bonds. We have term bonds. These are bonds that are all going to mature at the same time. We have serial bonds that are bonds that mature in installments at regular intervals. We have secured bonds. Those are bonds that are backed by the company's assets. So if you're not able to make good on your bonds, then your bond holders have rights to your assets. Okay. And then we have debentures. These are unsecured bonds, and they're backed only by the credit worthiness of the bond issuer. That means that the company might suffer a hit to their credit, but if they don't make good on their bonds, tough. Um, Notice that this could be a potential matching question, right? Because we've got a lot of related definitions on this slide. Okay, so let's talk bond prices. Um, so a bond can be issued at any price that's agreed upon by the issuer and the bondholder. In reality, um, individual bondholders are not negotiating with the company, right? This is a market situation. So it's whatever the market dictates the price will be. Okay. And a bond can either be at face value. Remember, that's the value that is printed on the bond, the amount that you will get at the end. Okay. It can be issued at a discount or a premium. If it's at a discount, that's when the issue price is less than the face value. And at a premium, if the issue price is above face value. So, um, the price information for our mock company, Smart Touch Learning, is as follows. 12 of Smart Touch Learning's 9% bonds, which will mature in 2027, indicated by this 27 right here, have been traded. Okay. The highest price on the day was $7.95. Okay. And the lowest price for the day was $784.50. All right. The closing price was $7.95. Okay. So, smart, Smart Touch Learning, 9%, matures in 27. 12 of them are sold. High was 79.5% or $795. Low was 78.45%, closed at 79.5. Okay. All right. So, the concept of present value and future value. Okay. So, as you know, money earns interest over time. The time value of money is a mathematical equation, a concept that we use to recognize that money is going to earn interest over time. Okay. The present value is the amount a person invests now to receive some kind of return in the future. Okay. And the future value is the value of an investment at the end of a specific time frame. Okay. So I'm telling you that so we can continue our discussion of bonds. All right. So, if a $1,000 bond reaches maturity 3 years from now and carries no interest, then $750 is a fair price. If you invest that $750 now and receive $1,000 later, you will earn $250 over the next 3 years, right? So you've paid $750 to get 1,000. That seems like a good deal, right? The stated rate is the rate printed on the bond, to remember that face value, right? And then the market interest rate, okay, also known as the effective interest rate, is the rate that investors demand to earn for loaning their money, okay? The interaction between these two indicates the price of the bond. Okay, so I'm sure, let's take a side note here. So I'm sure you've heard about how the Federal Reserve Bank can manipulate the market by setting interest rates. Those are the general lending interest rates, okay? So if you have a bond that you're selling that pays an interest rate that's lower than what the Fed has set, then you can expect to sell it at a discount, right? Because people aren't going to make as much from your bond as they would from other interest-bearing items, right? On the flip side of that, if for some reason your bond has a really high interest rate on it and it's higher than what the Fed is offering, then you can sell that bond at a premium. Okay. Okay. So, that is just bond pricing simplified. All right. So, when you're issuing your bonds, um, there is some risk involved because the company may not be able to pay that money back. Okay. Um, this debt is less expensive than stock because with a bond offering, you're only offering money in return, right? When you have a stock offering, you're selling off a piece of your company, okay? Um, if you are able to earn more income on borrowed money than the related interest expense that you have to pay back, that is called financial leverage, okay? It's a good thing. Um, so here is a comparison between issuing bonds payable versus issuing common stock. In both cases, you'll be receiving your net income is going to be 300,000 in both. Okay. Your new project is going to be $200,000, will generate that much income, right? Either way, with bonds payable, you will be paying this interest expense, whereas you will not have to do that with common stock. Okay. Um, then your common stock, you'll be hanging on to that income. Uh, your tax expense will be greater because you'll have a larger income, right? Um, the project's net income with bonds will be 118,500, 158 with stock. Okay. But then your earnings per share are not diluted here. So when you issued your bonds, you didn't give an interest in the company. So your earnings per share are higher here than if you had a stock issuance. There are more owners now. The stock is more diluted. The income is spread among more people. Okay. So journalizing these bond transactions. All right. So Smart Touch Learning has $100,000 of 9% bonds payable that mature in 5 years. The company issues these bonds at face value on January 1st, 2025. Face value, it means people paid $100,000 for them. Okay, so you received $100,000 in cash, and now you have this liability of bonds payable, just like any other long-term liability, $100,000. Okay, it's the opening journal entry, it looks exactly the same as if you had taken out a mortgage or any other kind of loan. Okay. All right. Then your interest is going to be paid on June 30th and December 31st. Okay, so when your first semi-annual interest payment is due, you are going to expense that interest of $4,500 and reduce your cash by $4,500. Pretty easy so far, right? Okay, so what happens if you had sold those bonds at a discount? So let's say that the Fed sets the interest rate at $10,000 and you're only paying, or I'm sorry, at 10%, and you're only paying 9%. Okay. So now your bonds look less valuable. So you're going to have to sell those at a discount. All right. So you have these $100,000, 9% interest 5-year bonds. They pay interest semi-annually. The market rate of interest is 10%, right? So Smart Touch Learning actually receives 96,149 and records a discount of 3,851. So cash you received is this 96,149 right here. And then your discount on bonds payable is your contra account, okay? But regardless of how much you spent or you charged for those bonds, you still owe $100,000 at the end, right? So your bonds payable is still going to be $100,000. Okay. Um, so when you report it on the balance sheet, you're going to have bonds payable of $100,000 less discount on bonds payable of 3,851, which we subtract to get how much money we actually got. So this looks a lot like how we record depreciation, right? When we have this contra account that reduces our asset account. Okay. So, as I said, that discount is going to be a contra account on our bonds payable. Bonds payable minus the discount gives the carrying amount of the bonds. It's also called the carrying value or the book value. Okay. Note that Smart Touch Learning has borrowed $96,149, but they still have to pay back $100,000. Okay. When the bond matures 5 years later. The difference, the discount, is recorded as additional interest expense, okay? The discount raises the true interest expense to 10%, which is that amount that the Fed set, okay? So this is how we amortize our bonds, all right? So we had this initial discount of 3,851. That discount is going to be divided over the 10 semi-annual interest periods, okay? And $385 is amortized each period, all right? So our interest expense, we're paying 4,885. We're reducing our cash by 4,500 because the other 385 is that discount we provided on the bonds. Does that make sense? Because this is one of those weird, a little bit more difficult concepts, okay? Is everybody with me so far? Silence is the affirmative. Okay. So, let me just scoot this over a little bit. So the same entry would be made again on December 31st, so that the discount balance would be 3,081 on December 31st, 2025. We reduce the discount on the bonds payable by $385 each time we're making that interest payment. Okay. And then when we put our financial statements out, that discount on bonds payable is going to reduce. Okay. Unlike with depreciation on an asset, depreciation gets bigger. Okay. Our amortization, our contra account gets smaller. Okay. All right. And here is the amortization schedule for our bonds. Okay. All right. So the opposite of that, when our stated interest rate is greater than the market value, we can sell our bonds at a premium. Okay. So an adjunct account is an account that is directly related to another account. Okay. Another vocabulary word for you guys to know. All right. So Smart Touch Learning issues its 9% 5-year bonds when the market interest rate is only 8%. So they're going to be paying more and their bonds are more attractive. So they can charge more for them. All right. So the bonds are going to be priced at 104.10, and Smart Touch Learning receives $104,100 in cash upon issuance. So our initial journal entry, we received cash of 104,100, but our liability is only $100,000. We're only paying those people $100,000 at the end of the bond term. So our plug figure is this $4,100. That's the premium. Okay. So we'll create this contra account that's going to sit on our balance sheet. Okay, that's our premium on our bonds. Okay, to show how much we have in that account. All right. So the beginning premium is going to be $4,100, and there's 10 semi-annual interest periods. So, 1/10 of the $4,100 of bond premium is amortized each interest period. So they paid us more than that $100,000 that we're going to pay them back. So each time we're going to chip away by reducing our interest this time instead of increasing it. All right. So here we have our interest expense of $4,090, our premium on bonds payable of $410, and our cash that we pay out of $4,500. Okay. So we'd make that same journal entry on December 31st, 2025, and reduce that bond premium further. Okay, here's the amortization schedule for that. All right. So what happens when we retire those bonds? We might actually get through all this tonight. Yay! So when you pay the face value of the bonds at the end of the term, that's called a retirement of the bonds. Okay, you could actually pay before the maturity date if you wanted to clear that debt, just like any other loan, you can pay it off early. When the bond is matured, the carrying value always equals the face value. So Smart Touch Learning has $100,000 of 9% interest bonds that mature on December 31st, 2029. Note that all interest has already been paid and the discount is fully amortized, okay? So all you're doing is paying off the principal. So bonds payable, we're going to zero that out at $100,000, and cash is going to be reduced by $100,000. Okay. And sometimes, again, companies are going to retire that um, bond early, just like any other loan. You can pay it off early if you want to. Okay. Um, and at that point, you're not going to have to pay any more interest payments. Okay. Um, some bonds are called callable bonds. That means the company can call that bond at a specific price. So on December 31st, 2025, Smart Touch Learning has $100,000 of bonds payable outstanding, and they have a remaining discount balance of $3,081. The company can buy the bonds in the open market for $95. So the face value is $100,000 less the discount that's still hanging out there. So the carrying amount of the bonds is 96,919. But if they cash out now, they can only pay 95,000. So they have a gain of 1919. Does that make sense? So they still owe 96,919, but the market value of these bonds is only 95,000. So when they pay them off to the bondholders, they actually have a gain there. Okay, because they didn't have to pay as much as if they had let it carry out to maturity. Okay. Then this is how you would record the journal entry to record that retirement of the bonds. Okay, bonds payable is on your books at $100,000 with a discount of 3081, but you're only paying out 95,000, so your plug figure here is going to be 1919. Okay. Okay. Be sure when you're retiring these bonds before maturity that you're recording the partial period amortization of the discount or the premium, either one. Okay. You're going to remove the portion of unamortized discount or premium that relates to the bonds. All right. You're going to debit bonds payable at the face value, credit cash in the amount paid for the bonds, and then your gain or loss is your plug figure. That's the difference between the face value and the amount that you pay to retire those bonds. Okay, so putting your liabilities on the balance sheet, okay? Remember that all current and long-term liabilities are going to be reported on the balance sheet. Excuse me. When a company issues bonds, the discount or premium is included in that section as a contra account, just like we included the oh, what do you call it? The opposite of amortization. I just completely blanked on when you have an asset, the somebody help me out here. Nope, no takers. It is the I just brain flog. Okay, sorry, I'm having a stroke or something because I can't remember the word, but it's okay. It's a contra account that goes in the liabilities section below the liability. Okay. Um, so this is an example of your balance sheet. Okay, with your long-term liabilities, notice that you have bonds payable here, and you have the discount on the bonds payable listed below as your contra account. Okay. All right. So now we're branching out in another direction. So remember that you've got that paper coming up where you're going to be doing a drill down into the financial statements on a company of your choice. Okay. So while you're doing that, A ratio that you might use is the debt to equity ratio. Um, this shows the total of your liabilities to your equity in a ratio, and it's going to measure that financial leverage that we talked about previously. Okay. If you have a ratio that's greater than one, it indicates that the company is financing more assets with debt than with equity. Okay. So here's an example. PepsiCo reported total liabilities and total equity on its fiscal 2021 annual report as follows. So, total liabilities here divided by total equity. So in 2021, their ratio was 4.72, whereas in 2020 it was 5.86. So almost 6. Um, so a lot of their assets were fueled by debt rather than selling their stocks. Okay. All right. So remember how we talked about time value of money? There is a formula to compute that. Remember, it just means that a dollar that you receive today is worth more than a dollar in the future. And the fact that, invested cash earns interest over time, it forms the basis of this time value of money idea. Okay. It's used to calculate the present value of a bond and its market price. Okay. Um, so it's a formula. These are the parts to the formula. All right. I will not ask you this on a test. All right. So you have P, which is your principal. That's the amount of the investment or borrowing. Okay. N is going to be the length of time, and I is going to be the interest rate. Okay. If you are paying simple interest, okay, that's when the interest is only calculated using the principal amount. All right. More commonly, you see this compound interest. This is when interest is calculated on the principal and any additional interest. Okay. All right. So this just shows you how interest versus compound interest is calculated. Okay. All right. So, in our example, the future value of an investment is the future value, principal plus interest. Okay. And if we know the future value and want to find the present value, we can find the present value. It's going to be the future value minus the interest earned. Okay. So the difference between that present value and the future value is the amount of the interest that's going to be earned in that span. Okay. So you have a formula to specify future values and present values using any interest rate I and any amount of time N. You have different formulas for single lump sum investments. Okay. But generally, we are going to use present value tables in order to look up the present value of our bonds. Okay. So in your text, I believe it's Appendix A. I didn't realize it was on the slide. So in Appendix A, you will be able to look up the present value of a dollar, the present value of an annuity of $1. That's, repeating payments of $1. The future value of $1 lump sum and the future value of an ordinary annuity of $1. Okay. Again, this is just a table that you go to and you look it up. Okay. We are discussing it conceptually so that you understand where these numbers come from. Okay. All right. So, an example of how you would use this, how much would you need to invest today to have $13,383 in 5 years if the interest rate is 6%? Okay, so you use the present value factor from the table, present value of $1, right? Because this is a lump sum. All right, and you just need the factor there, okay? So, your future value is going to be 13,387 times this factor that you just look up in a table, okay? And then you will get $9,997. That's how much you would have to invest now at 6% interest to end with 13,383. Okay. So an annuity is a series of equal payments over equal intervals. Okay. So in this, instead of receiving a lump sum at the end of 5 years, you receive $2,000 at the end of each year. All right. So in order to calculate this, present value equals the amount of each cash inflow times the annuity present value factor for 6% for 5 years. This comes from the table, okay? You just look this number up. It's going to be $2,000 times 4.212, right? So your answer is 8,424, okay? Here's an annuity table just to prove that the equation gets you an accurate answer. Okay, so you can use the present value of a lump sum and the present value of an annuity to figure out how much the selling price of your bond should be. Okay, so the present value of the bond, its market price should be the sum of the present value of the principal paid at maturity and the present value of the future stated interest payments as an annuity because you're paying them in periodic payments. Okay. Again, the value is looked up in that table in the appendix. Okay. But we'll go through an example of this. This is the last thing we have to do. So hang in there. Smart Touch Learning issues those $100,000 5-year 9% bonds that pay interest semi-annually. The market interest rate is 10%. So the maturity payment is going to be $100,000 and then periodic interest is going to be $4,500. Interest rate 10%. That's 5% semi-annually. Number of periods 10 because you have 2 payments a year for 5 years. Okay. So the present value of the principal is going to be, you're going to look up that present value of $1. Okay. That's the lump sum. Okay. So that present value is 61,000 or 400. And then your present value of the stated interest. Okay. So that's going to be the amount of the cash flow. All right. Times the annuity factor, which we just look up in a table. So that total is going to be 34,749. So then we're going to add this 61,400 to this 34,749 to find out that the value of our bonds is 96,149. So that's what we can get away with charging for them. Okay. I know this last bit was a lot. Okay. So do you guys have any questions on anything that we covered during class today? Oh, I see I've got some. Oh, Oh, no questions. Okay, I see that somebody asked, were you asking about the last test that we have? I'm sorry, I didn't see your chat before. Yes, it will be just like the last test that we had, not that first one where everybody had to come in person. I will post it on Canvas and you'll have the whole week to take that test at any time. Yep, sorry I didn't see that before. Are there any other questions? Okay, well, thank you so much for coming. I appreciate you hanging in there, and I will hang around if you guys have any more questions, but otherwise, have a great rest of your night, and I'll see you in a week for our last lecture.